Okay, hi everyone. This is going to be the video here for chapter 4. So let me kind of get this ready here. All right, so we're doing the problems here. We have 1, 2, 3, 4, 5, nothing too majorly over the top difficult. So we're going to be looking at some income statements, a statement of cash flows, and some ratios. So let's kind of start at this and unpack it one by one here. First one, they're giving us some information. They're saying, hey, the following is a partial trial balance for this company as of the end of the year. All right. They want us to prepare a single step income statement. All right, let me just make that yellow. And then they want us to do a multi-step income statement. We're just going to do one here because in the next problem, we're going to do a multi-step with it. So remember, right, we said single step is really just going to be all your revenues minus all your expenses. It's pretty straightforward. One step, total revenues minus total expenses. Whereas that multi-step is a little bit more specific, right? So let's check this out here. If we go through, right, and we're looking at this, we're going to have to classify, right? Remember, we want our total revenues minus our total expenses. It'll be like revenues and gains as well as like expenses and losses. But that'll get us to our net income here. All right, so let's make our revenues, right? We'll just make those yellow, and then we'll make our expenses blue. Okay, so right, this is single step. This is straightforward, right? They're already basically giving us all the revenues, right? So we're going to have right, our revenues and gains is that kind of title holder. We'll have our sales revenue and then our interest revenue. That'll get us our total revenue and gains, right? So we can just pluck this from over here, right? 2350, 1, 2, 3. Right, there we go. Interest revenue of 80,000. We'll add them together. And we're looking at 2,430,000. Okay. All right, let's do expenses. And I'll move this up one. And losses. All right, well, it's just going to be the remaining guys. Right, so it'll just be all of these guys that we have left. One thing they do say here that we'll come to is the income tax rate is 25% for taxes. So there is a little bit of like a trick here, but we can handle it. So let's kind of list these things out, the expenses, right? So we'll have our cost of goods sold. We'll have our selling expense. We'll have our general and administrative expense. We'll have interest expense, loss on the sale of the investment, loss on the inventory write-down, right? And that'll get us our total expenses and losses, right? So if we just pluck those numbers from over there, I'll move it in just to be consistent with how they're presenting it here. So we got 1.2, 300,000, 150, 90,000, 22.5, 200. Throw that little subtotal line there. You can sum this guy. Right, we're looking at $1,962,800. Right, so what this will get us is essentially our pre-tax book income, PTBI. Right, you may see that if you go into tax, PTBI. It's also income before taxes, right? And that's taxes with an E. So, right, we'll take our total revenues minus our total expenses, right? we're looking at 467 there. I can put the little subtotal again. All right, now, right, that was income before taxes. Now we got to back out the tax, right, the income tax expense. But if you look over here, right, they don't tell us exactly what it is, right? They don't give us the raw number, but they do tell us, right, that it's 25% of that pre-tax book income. Right, so what we can do here is take the 467, right, multiply it by 25%, right, we're looking at $1.16 there, right? So when we take our pre-tax income, back out our taxes, right, our net income is going to be $350,400, okay? The idea is if we did the multi-step, right, this $350,400, right, that would still be the bottom sort of line item there, the net income, but how we get there would be different, right? You'd still start with like the sales revenue, but you then have to back out the cost of goods sold. It's the same items, we just have to kind of reorganize it for them. So let's move to exercise 4.5 here. So again, they're giving us some information. They're giving us a single step right here, right? Our total revenues minus our total expenses. And can we prepare a multi-step income statement? Okay, so this is essentially what we would have done in that first problem had we, fully kind of completed it. That's why I said, oh, okay, we'll do it in problem 2. Again, a high level here, we're still going to get to that $1.20. It's just how we get there and how we unpack this may be like different than the total revenues minus the total expenses. Right, so when we have that multi-step income statement, right, we're really having a lot of those like stop signs, right? You got to work your way down, stop, do the subtotal. Work your way down, stop, do the subtotal. Okay, so here, right, they're giving us the information, right, our revenues and our gains, as well as our expenses and losses. Now we just have to kind of take that information and reorganize it under that multi-step, right? So we're going to start with the sales revenue, then we back out the cost of goods sold, which will get us our gross profit, right? That's like our first little stop sign there, right? So we'll have on this, if we pluck out the numbers from over there, 592, 325, and if we just do a subtraction there, computers, we want to do right, so it'll be the 592 minus the 325, right? We're looking at 267, okay? Computer's just being annoying here. All right, so next, right, we got our first stop sign. We got to hit up our operating expenses. Right, so here we'll have our selling expense. We'll have our administrative expense, right? These are things you think of whenever you're like operating your business. The restructuring costs, right? It looks like we incurred those this period, right? That'll get us our total operating expenses, right? So here, right, if we just pluck the numbers out, we're looking at 67,000. We're looking at 87,000. We're looking at 55,000. we sum those guys, right, 209. And then with that, right, we can get to our operating income. All right, so we'll take the 267, let me do it over here just because my computer's still acting funny, minus the 209, right, that'll get us 58,000. Right, so you can see, right, we sort of had stop sign 1, got to get that gross profit, stop sign 2, right, we got to hit and get that operating income. Now, right, we can look sort of at our other income, right, things that are a little bit more tangential to the fundamental reason we're a business. So if we look at our other income and expenses, right, what would this include, right, what would be like the interest revenue, the interest expense, gain on the sale of the investment, right, that'll get us our total other income. So if we were to, just pluck those numbers out, right, we got $32,000 there. We got an expense, right, so it's going to be a subtraction of 16,000. We got a gain on the sale of an investment of 86, right? If we were to sum these guys, right, we're looking at $1.02. Okay. So with that, right, we can then, I moved the 102 over here. Why is this not deleting? Okay, there we go. All right, that's our total other income, right? So what we'll do is we will add that, right? We will get our income. Oh, I don't want to sign. All right, we'll take our operating income plus our other income to kind of get our whole shoot and match of the income there, right? $1.60. Then, right, looks like here they're giving us the income tax expense, the 40,000. So we got to back out the income tax expense of 40,000. That will get us to our net income of 120,000. Right? You look at it, they both get us to the end of the road, 120. Right? Either way we do it, the single step, right, one step, or the multi-step with the stop signs, right? You got to stop at the gross profit, stop at the operating income, stop at the income before taxes. Finally, then you stop at the net income, right? And there's even broader stop signs if we were to just kind of talk about more of like income from continuing ops versus discontinued ops. But in this way, right, we're just putting some numbers to it. Nothing too hard here. It's just organizational, right? You got to know where things are and how we sort of classify it. Really, this comes through memorization, right? You write out this income statement 3 or 4 times, you'll be in pretty good shape. All right, exercise 4.8 here. They're giving us some information. All right, looks like we have a company. They have 2 operating divisions, right? One that deals in machinery and the other that sells horses, right? So I don't know what kind of company this is that's doing this, but they got some interesting things going on here. It looks like, hey, the horse division, right, has been unprofitable, and on November 15th, 2024, right, so if we go down here and we just put year 4, right, then we got year 5, right, on November 15th, so towards the end of the year, they have and adopt a plan to sell that horse division, right? So that is now going to make it a discontinued operation that we have to account for. They ultimately sell it over here in year 5, right, April 30th. And then they give us some additional facts, right? They say on the end of 2024, it was still held for sale. And then they say, consider the following, right? At the end of the year, right, it has a book value of $240 and a fair value minus cost to sell of $200, right? So that horse division. The before tax loss of the horse division was $1.40. The after-tax income from continuing ops was $400, and the company's effective tax rate is 25%. All right, a lot of information here, right? It's they're giving us a lot to it. What are they asking us to do? They're saying, can you, in requirement 1, prepare a partial income statement for 2024 with the income from continuing ops? Right, so they're kind of saying, all right, look, we'll give you the income from continuing ops and then just prepare the rest of the income statement, right? And that's why it's a partial income statement. We're not showing like everything under the sun here. It's a little bit truncated, right? So we know from the facts that the income from continuing ops, right, that's right here for 2024, that's $400,000, right? Now, because we have this horse division for sale, right, we got to account for that in discontinued ops, right, our discontinued operations. And we know from the lecture, right, whenever you hold it for sale here, there's kind of 2 things you have to account for whenever you're doing the financial statements at the end of the year. 1, what was the income or loss from that division, right, from the point in time we held it for sale to the end of the year, right? So we want to know, 1, sort of the income or loss. And then 2, we got to check, because we haven't sold it yet, right? We only sold it in year 5. Was there any impairment, right? Is this too puffed up on our accounting records? Do we need to kind of claw it down a little bit? All right, so with that, let's kind of unpack what's going on here, right? They tell us that division, the horse division, had a loss of, let's see here, 140, right? So we're going to use that, right? 140. That's one part of it. And then they tell us that let me check this out here. Our fair value and our book value, so let's kind of think about this here. Fair value is 200. That's what it's worth, but we're carrying it at 240. Book value, we have a $40,000 impairment loss, right? It's too big. We got to write it down by 40 grand. So how do we sort of deal with this here, right? So we will combine it, right? So we'll have a loss from operations on the discontinued ops, right? This will include, right? So I'm just going to put parentheses down here, include an impairment loss of 40, right? But if we were to quantify the 2 of them, right? The 140 plus the 40, right? We combine that over here. So we're looking at 180,000, right? The combo of the 140 and the 40. We have to then account for the fact that, hey, because this is a loss, right, that's going to give us an income tax benefit, right? When you have a loss on your tax return, right, in year 1, you can use that in year 2 potentially to offset your income. So it's kind of like an asset to you. That's a benefit you get in the future. So we need to make sure that we show that here, right? So what we would do is the 180,000 times, they're telling us we got an effective tax rate of 25%, right, we're going to get a future benefit of 45 grand. So whenever we would sort of net those things, right, we'll have loss on discontinued ops, right, when we say, hey, between the impairment loss and the actual operations itself, we're at a loser, 180, but we do get a little bit of a benefit with the 45. When we net the two of those, our sort of like overall loss, when we like truly look at it, is going to be 135, right? Accordingly, what we then will do, right, is solve for our net income, right? It's going to be basically, right, our income from continuing ops as well as the loss from discontinued ops, right? So we're looking there at 265 for our net income, right? It's basically continuing ops, discontinued ops, right? Those giant stop signs, right? Remember we said we have like sort of those like little baby stop signs in between, but that's how we would do it there, okay? Now, requirement, the next one here, it says repeat requirement 1, assuming the estimated net fair value was 400 instead of 200. So they're changing the facts here. They're saying if this was 400, there isn't going to be, in this case, any impairment. So whenever we would run the numbers on this, right, we would see 140 here, right? We would only account for the operations from the loss, and then it would produce a tax benefit of 35. Okay, so I'm not going to like recreate the wheel on all that, rewrite it out, but that's just a quick way to show you of requirement 2 there. There is no impairment in requirement 2, so we're just looking at the operation loss itself. Okay, we're moving along here. Let's do this guy right here. They're giving us some information, right? They're saying, hey, here's some transactions for 2024. We have some cash in, and we have some cash out. All right, so plus, minus. Our beginning cash was 17, and then they say, can you please prepare a statement of cash flows for 2024? They're basically wanting us to do this using the direct method. Right, so you remember with the statement of cash flows, it's going to be your beginning cash plus or minus your inflows from your operating, investing, and financing section, get you your ending cash. And sometimes they kind of like rearrange this. You do the O, the I, and the F first, and then you add to it the beginning cash, like the change in cash plus the beginning gets you the ending. But if we're looking at it in the base formula, right, that beginning plus additions minus subtractions get you the ending. This is kind of where you're at. And for the O, right, we're going to be using the direct method there on it, just to keep it a little bit simple. All right, so with that, we got the operating section. Let's start with the O, right? And because we're doing the direct method, it's basically, and we can just keep this yellow here, right? We're looking for any cash inflow or outflow that relates really to the reason we're a business, our operations, our operating activities, right? So this is going to include, hey, the collections from the customers, interest on notes receivable, right? So it's not the note receivable itself, but the interest on the notes receivable would go there. Likewise, hey, we spent some money to buy inventory. That makes sense. That would be like related to our operations. Likewise, we paid some interest on notes payable, right? So it's the interest on the note payable, not the actual note payable itself. And then we got some salaries to our employees, right? So if we were to just kind of throw these in here, right? So we have cash received from customers. We got cash received for interest. We got cash paid for merchandise inventory. We got cash paid for interest. We got cash paid for salaries. Okay, 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. Anytime it's an inflow, we'll put it as a positive. Anytime it's an outflow, we'll put it as a negative, right? So we got 380,000. We got 6,000. We got 160 outflow there. We got 5 outflow. And then we got 90 outflow. Right, if we sum these, just the raw inflows and outflows, right, we're looking at 131 there for our net cash flows from our operating activities, okay? And again, that was the direct method just because it's like you list out every single time you have the inflow or outflow. Next, let's do the investing section. Right, so we got the I here for investing. And let's make this guy blue, okay? So here, right, with investing, right, this is going to include things like PP&E, investments, right, notes receivable, like the underlying notes receivable. It's like things the company is investing in or they're planning on making money from. Right, that's not really from our operations itself. Right, so notes receivable, that underlying principal of the note receivable, that would be here as an inflow. Sale of investments, right, that would be an outflow. Go down, oh, we bought some PP&E, right, purchase of equipment. That would be an outflow. So one of the things here, right, you always have to be aware of is, yeah, they're giving us the raw number here, but you got to think, is this an inflow or an outflow, right? When you buy something, that's an outflow, right? It's like you open up your wallet and cash came out. When you collect on a note receivable or you sell something, it's like an inflow, right? If you're like a business and customer comes in and you sell them goods, they give you cash. That was cash in to you, right? So if we take these things, right, we'll have the collection on the note receivable. We'll have the sale of the investment. We'll have the purchase of the property, plant, and equipment. Right, so we got 50. 30. 85. Kind of just run the raw numbers on them there. Oh, going crazy here, right? This is not working well. Right, we got -5. Right, so that's going to be our net cash flow from investing. All right, we got the O, the I, we got to do the F, right? The financing section. So let's make this green. Right, financing. So again, this is kind of how you finance the business, right? It's usually like, oh, we issued stock, we issued a bond, right? Anything kind of associated with that. Right, so this is going to be all the leftovers, right? Like notes payable, we issued a note payable. Payment on that note payable, right? The underlying like amount there. Dividends to the shareholders. Right, so with this, right, we'll have the issuance of the note payable, payment on the note payable, dividends that we paid. Right, so we issued a note payable, we got an inflow there of 100 grand, right, we paid on it. Right, 25 grand, that's going to be an outflow. We paid a dividend, right, that's an outflow. We sum these guys, right, we're looking at 55 grand for our net cash flows from financing. Right, so if we were to sum right? Add together our operating, investing, and financing, right? We're looking at sort of a net increase there, right? That's the functional equivalent of plus or minus OINF, right? 181. We then talk about our beginning cash, right? So they tell us over here that's 17,000, right? So if we take our beginning plus, in this case, the change, the O, the I, and the F, the 181. So if we take 17 plus the 181, we're looking at ending cash of 198. Okay, nothing too unbelievably hard there. You just have to be organized with it. Sometimes it gets tricky with like note payable, note receivable, inflow, outflow. So just take it one step at a time. Think about it. It's nothing too bad, but you can do it. All right, finally here. We have exercise 427. They're giving us a bunch of information. They're saying, can you please calculate for 2024, right? So we're looking at 2024 here. Profit margin on sales, return on assets, return on equity for it, okay? And then afterwards, they're asking us for dividends. We'll see if we get to that, right? So let's look at these one by one, right? We'll start with the profit margin on sales. Right, so the equation for this is, right, the ratio is going to be your net income over your net sales. Right, so if we go down here, right, this is for 2024, right, so we're going to do net income 180 over 5,200, right there, right, so we'll have 180 5,200, divide it, 0.03, we can, going the wrong way there. Where's that? Oh, there we go. 0.035. So if we put that into a percent, right, you're looking at 3.5%. All right, how about this return on assets? Right, what's the equation for this? Right, well, it's going to be net income over average total assets. Right, now when they say average, they mean beginning plus ending divided by 2. Right, so we know our net income. Right, we just used that last time, $1.80. But average, right, they want, and what's that for? Our total assets. Right, it's going to be these two numbers, right? Our beginning of the year, right? Last year's ending is this year's beginning, plus our ending divided by 2, right? So if we do here, the 1,700 plus the 1,900 divided by 2, 1,700, so 17 plus 19 divided by 2, we're looking at 1,800 there. If we do 180, the numerator divided by the denominator, put that into a percent, we're looking at 10%. All right, how about return on equity, right, ROE? The equation for this, right, again, this is going to be the net income. Let me find the underline here. Over the average shareholders' equity, stockholders' equity. Again, so if they're dealing with average, right, we got to go, and remember, that's beginning plus ending divided by 2. So here, shareholders' equity, right, they're not giving us exactly, but if you know stockholders' equity, right, it's broken out between common stock or APIC and retained earnings. So we're going to basically, sum these two guys, right? So beginning is 500, ending is 550. So net income, a given. Here, a little bit of math, right? So it's going to be equal to 500 plus 550 divided by 2. Take the 180, divided by the 525. Convert that to a percent. Right, we're looking at, and let me bold that here, 34.3%, right? So our profit margin is 3.5%. Our return on assets is 10%. Our return on equity is 34.3%. Then what they want us to do in requirement 2 here, right? Let me kind of read this and check it out. So they're saying, can you please determine the amount of dividends paid to shareholders during 2024? Okay, so if you remember the retained earnings formula, right, it's your beginning retained earnings plus your net income. It would be minus a loss if you're at a net loss, minus your dividends gives you your ending. Right, so if that was for year 1, last year's ending becomes next year, right, year 2's beginning, right? So it's always like last year's ending is this year's beginning. So let's kind of think of this over here using that information. Our retained earnings at the beginning of the period. If we go over here, right, let me just use yellow. It's going to be $100. 100,000, right? That's in thousands. We're going to use the equation, right? We're going to add our net income, right? They're telling us here our net income is $1.80, right? We know, right, that our ending retained earnings is 150. Right, so they want to know what our dividends are. Right, we're solving for X there. So essentially what we're doing, right, it's just a little bit of math. It's, 100 plus 180 minus X equals 150. Right, you run the numbers on that, X is going to be 130. Right, if you did 100 plus 180 minus 130, that gets you to the 150 there. Okay, so none of this is too hard. I'd say, of course, hit up some multiple choice questions. I think those are helpful, and we'll see you in the next lecture.